Mr. R. Sreesankar, Head of Institutional Equities at Prabhudas Lilladher. Mr. Sreesankar, thanks for joining us. And, I'd like to start by asking you, keeping what's gone on in the last 5 days in the Indian markets into perspective and, what's happening globally as well, what variables are you keeping an eye on with respect to your expectations for the movements of the markets here on?
Okay, let's even look at last 5 days is a bit of a very short time period. Let's even look at probably in the last 1 month what's been happening. The rise in US yields, the way the US bond yields have been going on, a lot of people have been expressing concerns over what is happening around even in the US. For a moment, that could have a huge impact in terms of global flows, to which markets it will go and whatever the scenario was. Second, in the US, you've also been, Fed has been probably saying quite a lot in terms of they're going to raise rates, Probably you may see 3-4 times increase in rates, etc. But the rate rise has actually happened below what Fed has been warning. Or probably, in my personal view, they have managed their expectations very well so far. Now, come and look at what's happening in the Indian context today. As a result of all what has been happening around, US dollar actually, or rather Indian rupee has strengthened against the dollar. And that's the case with most of the emerging market currencies, most of the currencies as well. In the Indian market per se, you've had a great run for the mid caps and small caps. And I must say that even in many times that we have actually come back and said that there is a lot of growth which is happening in the small cap and mid caps indices or mid cap stocks, which has been going up much beyond what has been happening. And in the last 1 month, in the month of January, whenever the upward momentum has happened, markets moved up into a new high. Actually, most retail portfolios have actually seen a huge amount of hit because most of the stocks have corrected 20%, 30%, etc. from the peak. So you saw the Nifty moving up, but in reality, the underlying mid cap and small caps, many of them corrected. Now, let's even take the dump of till now. What has happened? The Nifty is down 1.54% in a month as of 12 February. Now, where you actually see the mid caps is down 7% and the small caps in that index is down, I think, 9.67%. So it's very clear the bigger, if I may use the word carnage has actually happened in the small cap space, because that segment has actually done very well over a period, and that has actually got corrected. And now you extrapolate this to the last 12 months in terms of a performance. Nifty is up 19.6%, whereas mid cap is up 25%, and the small cap index, if I look at it, is still up 30% YOY. So earlier you had the small and mid caps probably having a more than 100% appreciation when compared to the large cap indices. So you got that entire profits got shaved off. So to me, a great amount of fraud that was there in the mid caps and the small caps, that got corrected. And the very fact that there might have been leverage positions. The market didn't like the way probably the long-term capital gains introduction, etc. So there was disappointment over the budget. On top of it, what's happening in the US. So you had from the volatility, which probably simply was not there in the VIX, whether it is in the Indian context or in the global context, etc. Suddenly you found this volatility coming up and the carnage actually happened. To me, it is a healthy correction that was required. So if at a point of time if I had gone and said that probably the market range, trading range would have been 10,500 to 11,500, but that range now comes down between 10,000 to 11,000, at least in the near term that I can see.
Okay. Hi Sri, morning, this is Shraddha here. Just wanted to understand if you think that has some calm returned at least for now, or is it that the gains that we've seen in the US market on Friday and in Asia that we're seeing today, is it more of a short covering given the kind of sell-off that we've seen over the last 2 weeks or so?
Shraddha, that there will be a lot of short-term volatility, but the short-term volatility has to be viewed from what is in store for the future. let's look at even the corporate results that has come out so far in this particular quarter, for the quarter ended December 2017. I think in the BSE 500, that's a benchmark which I had actually taken, still results are yet to come in. Over the 400 and odd companies which have come out with the results so far, 420 or something like that, 29 now, when I looked at last on Friday, you're actually, for the first time in many quarters, a YOY increase of 23% in net profits is there. This is ex-financials. Huh? Okay, I'm specifically mentioning ex-financials for the entire segment. Now, yes, the third quarter of FY17 was not a great quarter because you had demonetization. But still, the first time we are actually seeing earnings net profit growth. And on top of it, when I actually look into it, in FY18, you have also not seen earnings downgrade happening for FY18. Still 1 quarter to go. That's fourth quarter is in progress right now. So you have actually seen certain improvement in FY18 earnings estimates by everybody. So this is a big welcome change. If that's the case, then you should see second half of FY18 to have a better earnings growth. You already had around 6.2% GDP growth in the first half. So second half will be better. So you should see that GDP growth numbers for FY18 to be back-ended much more better than what you have in the first half. Now, if I extrapolate this into next year, you will actually see a better growth coming in terms of not only growth in terms of it and earnings growth as well. Our own estimate at this stage is you should probably end up seeing closer to 18% earnings growth in 18.7, 19% earnings growth for next year. And that's coming to be extremely positive. That's where I'm coming from.
Okay, Sri, so to what extent are you factoring in this 18-19% in terms of earnings? Because in that case, how are you reading valuations with respect to, say, the valuations of the BSE 500? And what are the challenges then? What are the risks to these earnings growth going forward?
See, if I go back and break the entire Nifty earnings growth, this is I was speaking about for Nifty. Sensex also is around what we are seeing is closer to 19% kind of a growth. Because now, if I look at the Nifty per se, a significant amount of earnings growth has to actually come from banks. Banks, it's something which is very interesting to be noted. Beginning of the year, banks with a 35% weight in the Nifty has got a huge overbearing of the entire Sensex and Nifty growth. Beginning of the year in April, May, the estimated growth in terms of banks as a sector, financials, let me put it up that way, financials were closer to 35-36%. Now, it has come down to 16.7%, 17%. So a significant amount of earning downgrades have actually happened from banks. Now, with banks or financials, we break it up into two parts. One is the pre-provisioning operating profit growth. Second is your net profit growth. What we have seen is, thanks to NCLT 1 and NCLT 2 and IBC referrals, etc., there has been a significant front-ending of provisions, which meant that the provisioning actually went in pretty high, which resulted in certain losses. So you would have seen SBI and Bank of Baroda, etc., putting higher slippages, higher provisions, etc., which took SBI into a loss kind of scenario even for third quarter. A similar kind of scenario which has happened in most cases in PSU banks and in certain cases in private sector banks. So you have seen a significant reduction in the earnings. Now, come for FY19, the banks is estimated to give a 36.5% growth. Private sector will continue to have a stronger growth. Public sector, if your provisioning continues to remain high, then this growth is going to be in question. Because this is after provisioning. What happened in FY18 is provisioning became much higher than what was anticipated. You have to revise the provisioning upwards for Q3 and Q4, etc. Now, we hope that this significant amount of provisioning would has already taken care. Otherwise, you probably will see a certain amount of corrections in the financial services earnings also estimated. So the bigger point out here, which is going to move the needle, is going to be the financials.
Sure. I do agree with you, Sri, that that earnings story has started to play out, and that's what we're seeing in this quarter. But you see this as a time to go shopping for value buys, or do you believe that we are better off waiting for larger discounts that could possibly come before one can actually go ahead and deploy cash?
Again, Shraddha, my view is in a value buys, you find it actually in a bear market. You don't see it in a bull market. Bull market, mostly it will be growth with relative valuation. So the point still remains that if you had in FY17, a better part of last 12 months, etc., many of the mid caps running the way it is, and it's unlikely to see it to happen in the current year. Current year, it's going to be more stock specific, sector specific, where the growth is going to be dependent rather than anything and everything that had a great run in last year.
All right, Sri. So my final question to you would be, what are the pockets in the markets that still need to catch up with, say, the rest of the markets in that case? What are those areas that still have a little bit of value left?
See, let's look at even some of these kind of things. Again, I'm repeating, I'm not talking about value. If you talk about value here, the pharma is one segment which has actually underperformed. And if you believe that the generic pricing pressure that you have been seeing in the US is coming to a close, which I don't think so even now. That's why that's what the guidance given by some of the pharma companies. You will at some point of time start to see these companies starting to benefit. So you see pharma, and then steel has started recovering, metals, commodities have started to improve. The bigger key question is, commodities for a better part has not participated, except in the last 1 year, steel has done pretty well. Now, if the global growth is going to be stronger, strong the way it is in FY17, FY18 also, it's expected to be stronger. If it remains stronger in FY18 also, and if the kind of withdrawal of a lot of those easy monetary policies by central banks starts to happen, then you need to rework your thought process. Where is going to be the dollar versus other emerging market currencies in terms of an exchange rate, and where your strengths are, etc. Still, we think that some of these stories like the chemicals playing out, the growth momentum playing out. The only issue is that you find that housing loan companies, etc., the growth has actually slowed down. Still, they will continue to grow. Whether they will grow at 18% or 15% is a relative call that one has to make. So we think financials will still continue to do well. You'll think that there could be pockets of value coming up in pharma. We like Aurobindo, we like something like the Thyrocare, the pathology lab place, etc., which will continue to do well, and the consumption story per se. And you will actually start to see the benefit of GST implementation coming into some of the logistics companies, VRL, etc. So clearly benefiting some of these guys, some of these companies, and actually benefiting to see. So I think it will be a plethora of those companies which will continue to benefit.